I don't know why anyone would want to hire a business broker who actually hasn't operated a business and, more importantly, sold a business that was successful. But it happens a lot, and it happens in our industry quite a bit. And in my opinion, it's costing sellers hundreds of thousands of dollars. So instead of telling you to just ask around and call people on the phone and get recommendations, I'm going to break down exactly the questions that you should be asking a business broker or an M&A advisor so that you can figure out who the real operators are with experience and exits, and really just the pretenders that are out there who have been selling insurance, cars, or even fitness memberships, and why their lack of experience could cost you 6 and even 7 figures in the transaction. If you follow this, you'll know more than 95% of the sellers out there when it comes to vetting a broker. And you'll be able to protect the transaction and those funds for the rest of your life. Number one, most sellers, they pick a business broker or an M&A advisor the same way that they'd pick a realtor. And right out of the gate, that's a $500,000 mistake. Most sellers, they're gonna pick a broker who's probably called them several times and followed up several times. Kind of a lead generation, kind of an outgo prospecting type of broker. Maybe who quoted the lowest fee or who sounded the most confident in a meeting. That's basically the same way that somebody picks someone to sell their house. But your business isn't a house. And the guy who can sell a $600,000 home has no idea how to sell a business. Especially position that business, say it's $5 million, to a private equity firm, to high net worth individuals looking to acquire. A lot of people are getting into the business broker space because they see the high fees and they look at it as low-hanging fruit. An easy way, in their opinion, to make a whole bunch of money. The pattern is almost always the same. Somebody was selling insurance, maybe they were selling cars, fitness memberships, some type of sales, and they see the high transaction, high commission volume, and they think, oh, this will be easy. I'll just transition my skill set right into that. They go and they take a weekend certification course, and suddenly they're advising on a $10 million exit. This is one of the most critical transactions that a business owner will ever have in their entire life. And hiring somebody with little to no experience is extremely risky. So the first question you ask a broker, it's not about their fee. It's about their operating experience. Have they ever run a business themselves? Have they ever sold one of their own personal companies? If the answer is no, or they deflect and say, oh, look, I've represented 10s, 20s, even hundreds of deals without naming a single business that they've sold themselves, you're talking to somebody who's learning on your dime. Your retirement shouldn't be their training ground. That's the experience gap on a deal itself. But honestly, there's a faster way to spot a pretender before you even get into their track record. And it's almost something that every seller overlooks. It comes down to, is that person successful in their own life? Or are they just good at talking? Number two, I wouldn't hire a broker who lives in a $300,000 apartment. Most sellers, they're vetting brokers just based on their credentials. The certifications, how many deals they've closed, maybe a testimonial or two. But they never ask, in my opinion, the most critical question. And that is, do they have actual skin in the game? Can they demonstrate to you that they're successful in their own personal life, in their family life, in their business life? And are there signs that you can visually see that this person has achieved success? Or are they just good at talking? I'll say it plainly. I would not trust a broker with a $5 or a $10 million transaction if they live in a $300,000 apartment. If they're not representing themselves as successful on their own accord, why should you be taking business advice from them? This isn't about being judgmental. It's about congruence. If someone's advising you on how to extract millions of dollars out of a business exit, in my opinion, they need to have done it themselves. The deeper issue is mindset. A broker who's never really built any wealth themselves is likely operating with a mindset of scarcity, and they're not in abundance. That means they're incentivized to close your deal as fast as possible to generate their fee or commission, even if waiting another 90 days would position you and the broker to make more. Everybody's got a great pitch. Very few people have the character to actually follow through. So the real vetting filter, it's not in how many deals you've closed. It's what business have you personally owned, operated, and successfully sold. If they haven't done it themselves, they're advising you based on theory and other people's deals. That's not enough when it comes to dealing with professional buyers and skilled negotiators who will exploit every inexperience and gap that your advisor has. You need somebody who's been in that exact seat Someone who's had to answer the buyer's questions, defend their own financials, and carry the emotional weight of selling something that they've built. That's the only way they're truly going to understand what you're going through and how to protect you during that transaction. Number 3, the 5 questions that separate real advisors from pretenders. Sellers think about success fees and how many deals somebody's closed based on contingency, and that should count as due diligence. It doesn't. Those are table stakes. The real vetting happens when you start asking questions that only somebody with operating experience can answer with specifics. There are 5 questions that I'd use to separate a real operator-led advisor from a car salesman who just walked into the space. And you can use them on every first call you have with any broker or advisor. The first question is simple. What business have you personally sold? If they've never owned one, they can't understand what it's like to have their own capital at risk. There's really no better understanding than having done it yourself. The second question should be, how many businesses have you actually owned? If the answer is 0, they're advising you on a process that they've never lived. They don't know what the emotional weight feels like. They don't know what happens when buyers test you. And they don't know what levers matter in negotiation. The third question should be, how many deals have you closed when you were the lead advisor? The industry average is 12%. If they're not closing at least 40 or 50% of the deals they represent, they're either taking on bad leads and deals, or they do not understand how to get a deal across the finish line. I'm closing over 75% of the companies that I represent currently. The fourth question should be, what types of business have you sold? A broker who's only sold pizza franchises has no idea how to sell a B2B software company. A dairy farm is not going to sell the same way as 10 Subway franchises. Domain experience matters. And the fifth question is the real test. Can you walk me through a deal where the buyer tried to renegotiate the LOI? And how did you handle that? If they can't give you a specific story with some names and some examples on exactly how they protected their client, the seller, they haven't been in enough high stakes negotiation to protect you when or if this happens inside your deal. When you're listening, after asking these questions, you want to listen for specifics, not generalities. Real operators, they're going to speak in specifics and they're going to give you specific examples because they've actually lived them. The pretenders, they'll pivot and they'll give you broad range examples of what possibly could happen. They'll talk about credentials, the certifications that they've earned. I've represented hundreds of deals without ever naming a single business that they've personally built. It should be a red flag. Most sellers, they don't dig in like this. They assume the broker is qualified because they have a website and they've got a great pitch, or maybe they're associated with a big franchise group that looks credible. When you're trusting someone with the largest transaction of your life, don't assume you should verify. Number 4, why contingency-based brokers outperform retainer fee brokers and how to tell the difference. A lot of sellers, they think that by paying a retainer up front shows the broker that they're serious and committed. I read it the exact opposite way. Don't hire somebody who wants money up front. They're looking to subsidize their lifestyle. If a broker is truly confident in their skills and their ability to close deals, they'll bet on themselves every time. You want an advisor that's going to bet on their skill set and their ability to close this transaction for you. That's the contingency model, the no upfront fee. The broker only earns a commission if he actually closes the deal. And the reason this matters is it incentivizes alignment between broker and seller. If the broker only gets paid when you get paid, they're motivated to maximize your outcome, not just generate activity. If you compare that to a lawyer who bills $500 an hour, regardless whether the deal closes, you could rack up $50,000 in fees. And even if the buyer walks, I guarantee that attorney is going to want to get paid in full. My philosophy is completely opposite. If we can't execute, you don't have to pay us anything. I don't think you should have to pay a guy if you can't deliver the results that you're looking for. So when you're interviewing brokers, you want to ask them specifically about their fee structure. Do you charge a retainer or do you work on contingency? If they quote a retainer, ask why and listen for whether they're confident in their close rate or just hedging their bets. The right answer sounds like this. I work on contingency. I only want to get paid when you get paid. Talking point number 5, the real reason inexperienced brokers can't protect you when buyers renegotiate. Buyers have a playbook. After they sign the letter of intent and you've stopped talking to other buyers, they come back in due diligence with findings. Maybe your customer concentration is higher than you expected. Maybe your owner salary is too high. Maybe there's a key employee risk. And when they renegotiate the purchase price down by $200,000 or $500,000, an inexperienced broker, they're not going to see this coming until it's already happened and you've lost the leverage. Think about a $5 to $10 million transaction that almost fell apart during due diligence. That's not bad luck. That's the buyer's strategy. Here's how it actually works. The buyer signs an LOI at $5 million. The seller stops marketing the business. They take it off because they think the deal is done. The buyer starts due diligence, which is designed to find weak points inside the deal. 3 weeks in, the buyer comes back and says, we found some concerns. We need to renegotiate down to $4.5 million, or we're going to probably have to walk. The seller panics because they've mentally already locked in on the $5 million purchase price, and they really don't have another buyer lined up. So they struggle, but they end up accepting the lower price. The buyer just saved $500,000 by exploiting some weaknesses during the LOI, and it was to the buyer's advantage. The only way to block this is that you have to see it coming in advance. The pitfalls in negotiating these deals can be treacherous. If your broker's done 200 deals, they've seen this move probably 50 times. They know how to structure the LOI to protect the seller and limit the renegotiation window. They know when finding a legitimate weakness versus a pure negotiation tactic and the difference between the two. If your broker's on deal number 5, they've probably never seen this, and they'll advise you to accept and just renegotiate so that you can keep the deal going and they can collect a fee. So when you're vetting brokers, ask them to walk you through a time when a buyer tried to renegotiate the sale after signing the LOI and how they handled it. The right answer should include a specific deal. If they can't give you a specific story, they haven't been in enough deals or transactions to protect you when this happens or potentially could happen inside of your deal. Number 6, why most sellers never realize they hired the wrong broker until after the deal closes. Sellers aren't going to realize whether they hired a good broker or not until they've actually sold their company. You won't know if you left $300,000 on the table until it's too late to go back and renegotiate. That's why vetting a broker before you hire them is the single most important decision that you can do inside of this process. Because once you realize that you've hired the wrong person, the money's probably already gone. Picture 2 businesses in the same industry with the same numbers, relatively same EBITDA, selling in the exact same year. One hires an operator-led advisor. The other hires a broker who transitioned out of real estate within the last 6 months. The operator advisor first positions the business as a strategic acquisition with defensible moats and real growth upside. They run a competitive process with 5 qualified buyers. The final sales price is $6 million at a 5 times multiple. The inexperienced broker lists the business exactly the way it looks on the P&L. No strategic narrative, no competitive tension. One buyer makes one offer. The final sales price is $4.2 million, 3.5 times multiple. Same business, $1.8 million difference when it came to sold price. And the second seller, they don't even know that they left money on the table because they really had no comparison at that point. They think they got a fair deal because the broker told them that's the market rate. Sellers really need to wise up, perform more due diligence on the broker, and get rid of these pretenders. Your retirement is too important to let somebody who's inexperienced handle this transaction. If you're thinking about selling your business within the next 1 to 2 years and you're curious or you just want to know what your business is worth, I'm offering the opportunity for a free business appraisal. Normally we charge $3,000 for these appraisals, but if you click in the link below, go ahead and value your business, tell you what the market looks like, what you could get, what you could potentially get if you make some changes. There's no obligation, no fees attached. Click the link below to schedule that.